If you own SCHD, or you're thinking about buying SCHD in 2026, there's one mistake you absolutely need to avoid. And surprisingly, it has nothing to do with SCHD being a bad ETF. In fact, SCHD remains one of the most popular dividend ETFs among long-term investors. But popularity can create a problem, because some investors are buying SCHD for reasons that have absolutely nothing to do with what the fund was actually designed to accomplish. And when SCHD doesn't perform the way they expected, they sell, they switch strategies, or they start chasing whichever ETF happens to be performing best at the moment. So today, we're going to talk about what I believe is one of the biggest mistakes SCHD investors are making in 2026, why it's so easy to make, and how avoiding it could completely change the way you think about this ETF. Welcome back to Asset Index. Let's get into it. First, let's establish something important. SCHD is not designed to be everything for everyone. SCHD is the Schwab US Dividend Equity ETF, and its strategy is centered around established U.S. companies with strong fundamentals and a history of paying dividends. But this is where the problem starts. Because many investors don't buy SCHD because they understand the strategy. They buy it because they hear other investors talking about it. They see dividend payments online. They see people building massive SCHD portfolios. And eventually, SCHD starts to look like an ETF that can somehow do everything: growth, income, retirement, passive income, capital appreciation, and maybe even outperform the market, all at the same time. But that's an unrealistic expectation. And that brings us to the biggest mistake: buying SCHD without clearly understanding what job it's supposed to perform inside your portfolio. Think about that for a second. Why do you own SCHD? Is it because you want maximum capital appreciation? Is it because you want dividend growth? Are you trying to generate income today? Are you building income for retirement 20 years from now? Or did you simply buy SCHD because everyone else seemed to be buying it? Those are completely different reasons, and they can lead to completely different investment decisions. Let's say you're 25 or 30 years old. You have decades before retirement, and your number one goal is maximizing long-term portfolio growth. In that situation, you need to ask whether a dividend-focused ETF should represent a large portion of your portfolio. That doesn't mean SCHD is bad. It simply means your investment needs to match your objective. Now, imagine another investor. They're approaching retirement. They've spent decades building their portfolio, and now they're beginning to care more about reliable income, dividend growth, and owning profitable established companies. For that investor, SCHD may serve a completely different purpose. Same ETF, different investor, different objective, and potentially a completely different answer. This is something that gets lost in ETF discussions all the time. People ask, is SCHD better than VOO? Is SCHD better than VTI? Should I sell SCHD and buy a growth ETF? But the better question might be, what am I actually trying to accomplish with this money? Because without answering that, comparing ETFs becomes almost meaningless. Now, there's another mistake that often comes immediately after this one, and that's performance chasing. Imagine you've owned SCHD for a while. Then you look at another part of the market. Maybe technology stocks are soaring. Maybe a growth ETF is producing much stronger returns. Suddenly, Your SCHD position starts looking boring. You begin calculating how much more money you could have made somewhere else. And eventually, you think, maybe I should sell SCHD and move everything into whatever is performing better. This is where investing can become dangerous, because the ETF that's performing best today won't necessarily be the ETF performing best 5 years from now. Markets move in cycles. Growth has strong periods. Value has strong periods. Large cap stocks have strong periods. Smaller companies have strong periods. Dividend strategies have strong periods. And investors who constantly move their money toward whatever recently performed best can end up buying after prices have already risen, and selling investments after they've already underperformed. Essentially, buying high and selling low. The exact opposite of what most investors are trying to accomplish. Now here's where SCHD becomes particularly interesting. Because SCHD isn't simply trying to find stocks with the highest dividend yields. And that's an important distinction. A massive dividend yield can look incredibly attractive, especially if your goal is passive income. But sometimes, a very high yield exists because the company's stock price has collapsed. And if the business is struggling, that dividend could eventually be reduced or eliminated completely. SCHD takes a more selective approach. The strategy considers characteristics such as dividend history, cash flow, return on equity, and the financial quality of the companies it owns. The objective isn't simply, give me the biggest dividend possible today. The idea is closer to, give me financially stronger dividend-paying companies that may have the ability to continue rewarding shareholders over time. And that difference matters, especially for long-term investors. But there's another misconception we need to address. Dividends aren't free money. This sounds obvious, but it's easy to mentally separate dividend payments from the value of the investment itself. You invest $10,000. A dividend arrives, and it feels like the investment just created money out of nowhere. But ultimately, what matters is your total return, your dividends, plus the change in the value of your investment. That's why simply choosing whichever ETF has the highest yield can be misleading. Imagine investment. A produces a very large dividend, but barely grows over the next decade. Meanwhile, investment B produces a smaller dividend, but experiences significantly stronger capital appreciation. Depending on the numbers, investment B could ultimately create considerably more wealth, even though its dividend was smaller. And this is exactly why SCHD investors need to know their objective. If you're buying SCHD because you believe dividends automatically make it superior to every growth-oriented investment, that's probably the wrong reason. But if you're deliberately building a portfolio around quality companies, dividend growth, income, and long-term compounding, then the conversation becomes very different. Now let's talk about something else investors sometimes underestimate: reinvesting those dividends. Imagine you invest in SCHD, and instead of spending every dividend payment, you reinvest it. Those dividends purchase additional shares. Those additional shares can potentially generate additional dividends. Those dividends can then purchase even more shares. And over a long enough period, you begin creating a compounding effect. At first, it may not look impressive. A small portfolio produces relatively small dividend payments. And this is where many investors lose patience. They see someone online receiving hundreds or thousands of dollars in dividends. Then they look at their own account, and maybe they're receiving $20, $40, or $100. It can feel like you're getting nowhere. But those larger dividend portfolios didn't appear overnight. They were often built through years of contributions, reinvestment, market growth, and patience. Which brings us to another major problem: comparing your beginning to someone else's finish. If someone has a $500,000 portfolio, their dividend income is naturally going to look very different from someone investing their first $10,000. That doesn't mean the smaller investor's strategy isn't working. It means they're at a different stage of the process. Now, does all of this mean everyone should buy SCHD? Absolutely not. And that's important. There are legitimate reasons SCHD might not fit your portfolio. Maybe you're focused almost entirely on aggressive long-term growth. Maybe you don't care about dividend income. Maybe you already have significant exposure to the types of companies SCHD owns. Or maybe another diversified investment simply fits your overall strategy better. That's completely reasonable. The mistake isn't deciding SCHD isn't right for you. The mistake is buying it without knowing why. Or selling it simply because something else performed better recently. Your portfolio should have a purpose. And ideally, every major investment inside that portfolio should have a job. One investment may provide broad market exposure. Another may focus on growth. Another may provide international diversification. And another may focus on dividend growth. The exact combination will depend on the investor. But once every investment has a purpose, short-term performance becomes much easier to put into perspective. Instead of asking, "Why didn't SCHD beat everything this year?" you can ask, "Is SCHD still doing the job I bought it to do?" That's a much more useful question. Because investing isn't about collecting ETFs like trading cards. More isn't automatically better. And constantly changing your portfolio doesn't automatically make it more sophisticated. Sometimes, a simple portfolio that you understand and can actually stick with is far more effective than a complicated portfolio you're constantly second-guessing. So let's bring everything back to the original question. What's the biggest mistake SCHD investors are making in 2026? It's not necessarily buying SCHD. And it's not necessarily selling SCHD. It's owning SCHD without understanding why you own it. If your goal is maximum growth, evaluate SCHD through that lens. If your goal is dividend growth, evaluate it through that lens. If your goal is retirement income, evaluate it through that lens. And if SCHD no longer fits your strategy, then changing your portfolio may be completely reasonable. But don't make that decision simply because another ETF had a better year. Don't make it because of something you saw on social media. And don't make it because you're impatient. Make it because your investment strategy requires it. Because ultimately, the best ETF isn't necessarily the ETF with the highest dividend, the highest return last year, or the most attention online. The best investment is the one that actually fits the job you're asking it to perform. And once you understand that, SCHD becomes much easier to evaluate. If you found this video helpful, subscribe to Asset Index. We break down ETFs, dividend investing, passive income strategies, and long-term wealth-building concepts in simple, practical terms. And I want to hear from you. What is the main reason you own SCHD? Dividend income? Dividend growth? Retirement? Or simply long-term wealth building? Let me know in the comments. And if you're still wondering whether you should continue buying SCHD in 2026, check out our previous video. Should you stop buying SCHD? Because that video breaks down the other side of this conversation. And together, these two videos should give you a much clearer picture of where SCHD may or may not fit into your portfolio.